Each year, Microsoft Research hosts hundreds of influential speakers from around the world, including leading scientists, renowned experts in technology, book authors, and leading academics, and makes videos of these lectures freely available.
Hello. Thanks for coming here. When I saw the list of authors, I thought we need bigger audience. Sometimes we have fewer audience than the number of authors in the talk. I'm glad that we are, yeah. So today our speaker is Dave Pennock. He's from Yahoo Research. He's been there quite a long time. And he's also one of the MIT TR35 award winner. And I think he's also related to Microsoft before I was. He was an intern here in 98. And I got related to Microsoft in 2000, very first time. He will be presenting his work on combinatorial prediction markets. Dave.
Okay. Thanks a lot, Kamal, and thanks everyone for attending. I'll be talking about combinatorial prediction markets, and some of the work I'll talk about is joint work with these authors. So before I talk about a combinatorial prediction market, I'll talk about a prediction market. And some of you may know what this is, but so bear with me. But essentially, it's this is the basic idea. We take a random variable, some uncertain variable that we'd like a prediction about, like whether Osama bin Laden will be captured by September 2009. Say this is something that it would be useful to know the probability of. And we turn it into a financial instrument. It pays $1 if that thing happens, if he is caught, and otherwise it's worthless. So if you buy this thing, and he's caught, it's worth $1. If he's not caught, you just tear it up and throw it away. So then you can think about how much you'd pay for that. Well, of course, you'd pay for it. You know, it's related to what you think the probability of that thing happening is. And if you're roughly risk neutral, which you probably are for small amounts of money, you'll probably pay almost exactly whatever you think the probability of that thing happening is. And then if you think about lots of people making this decision, and this is an open marketplace, many people can buy it, many people can sell it, and this system reaches some kind of stasis or equilibrium, you can think this is a consensus point where everyone's at that moment agreeing in some sense that that's the probability, or at least they're not willing to put up more money to change it. And that's a lot of opinions that are quantitative, and they're credible because there's actual money behind it, and it's an aggregation of lots of opinion. And it turns out that empirically, this kind of system works quite well for anyone can. Yeah. So the point of, I guess, a slight difference from a prediction market. So really, it's no different in some way than any other financial market. But except that your goal is really for information. So if your goal is truly information, then you want insiders you want insiders as well. You want everyone who has information. Okay, so it's not just hypothetical. You actually can take your money and go to intrade.com and open up an account and buy this claim. So here it is right here. Osama captured September 2009. And it's a double auction, just like the stock market. So this is the highest amount someone's willing to pay for that coupon. This is the smallest amount someone's willing to sell it for. So between 11 and 12%. So what you can read is this market thinks there's roughly between 11 and 12% that chance of that happening.
Conditionalized is still being alive, of course.
Oh, neutralized.
I guess you have to click on this and read exactly the definition. This is a clarity test problem, but I don't know exactly what the definition is. So, okay, so you may or may not agree with that probability, but that's kind of the point. So if you disagree with that, you think it's way too high or too low, you get out your checkbook and go here and invest your money, and then you'll be injecting your information or your opinion into the system.
Can I short sell?
Yeah, you can short sell. So it's you don't think of it like a stock market where there's a certain number of shares out there in the world. Really, all selling is meaning buying the negative thing. So you're just entering in a contract that says when you lose money and when you win money. It's not so you don't have to say short sell. You can just say I'm selling or I'm buying the negative. In other words, you don't have to borrow. You don't have to like borrow the share in order to sell it. This kind of thing. Any more questions? Yeah, you put up collateral. So InTrade keeps track of. They know like the maximum amount you could lose, and then they put it aside. At least if you're a small-time person, they put aside all the money you could possibly lose. I guess if you're a big trader, they'll allow you margin. Okay. So there's a whole bunch of these things you can do with real money, like things about the recession, things about tons of things about elections, and there's a whole industry of things that you can do without money, or there's sort of games that you can play. The news futures, the Hollywood Stock Exchange, this PopSci prediction exchange, and there's a whole. Probably a lot more of those sites out there that you play with play money, and then there's a few that you can do with real money. Okay, so so before I get into the pitch about combinatorial markets, I'll just give very, very brief description of a non-combinatorial market, or basically how a stock market works for buying and selling one thing. This is called the continuous double auction, and let's say you're selling one object like Acme stock, and you have a bunch of people willing to buy it, a bunch of people willing to sell it. All we do is we just sort them, and this is, right now the highest offer to buy is lower than the lowest offer to sell, so no one's willing to do anything yet. Then someone new comes in, they're willing to sell for less than someone else is willing to buy. So those two people, they agree with each other. In other words, they're willing to trade. So this trade happens instantaneously, and it happens at price 150 because that was the first one in the queue, and they go away, and then we keep going. So this is how what's called a continuous double auction works, and this is just used pretty much everywhere, all over finance, all over gambling. More and more in the gambling world, stocks, options, almost every kind of financial instrument, it all runs through this type of continuous double auction. And that's fine, and that's, in fact, it's good in the most cases, but it almost has gone to the extreme where even if you have related things, two things that are logically related to each other are very, very closely related. Like a strike, here's an option to buy Yahoo stock at 10, and here's an option to buy it at 20. Well, this one's, it's logically guaranteed that this has to be worth at least as much as that. But yet, the way it works, if you go to an options exchange, they're both two different continuous double auctions that operate completely independently. Or if you go to the horse track to bet on horses, you can bet on a horse to win, or you can bet on a horse to come in first or second place, right? And it's guaranteed that the odds to come in first or second has to be at least as much as to win come in first. But it doesn't matter. These bets go in one place, these bets go in another place, and they don't automatically affect each other. And this relationship's not automatically taken care of. Okay. And now there's all kinds of power set financial instruments, meaning like sets of things, like mutual funds are sets of stocks and exchange-traded funds. Things like a butterfly spread. A butterfly spread is like you want to bet that a stock comes in a certain range, comes within a certain range. In order to do that, you actually have to buy and sell four different options to put that together. This is called a butterfly spread. So you pay a commission on all four things, you have this execution risk where you buy one piece of it and the price might change on the other pieces. When you're placing a bet that, okay, you get the point. These are sets of things, but the way that it works currently today is you have to go in and buy each thing separately in a separate queue. So the basic thing I'm arguing is wrong is that this type of thing, it's treating everything like apples and oranges, even when it's like these are hamburgers and cheeseburgers. Like I know for sure a cheeseburger is worth more than a hamburger, but yet I'm treating them completely differently. Okay, so you get the
arbitrage make the constraints happen.
Yeah, sure. So the traders take care of it. You're right. Arbitrage. So if you look on the options market, they are correctly priced because the traders took care of it. But I guess my point is the traders shouldn't have to worry about that, especially for a prediction market. I don't want them to be spending time on this kind of mechanical thing that a computer can do way better anyway. I want them to spend their time on giving me information.
There could be much less obvious cases where the combination of these three bets dominates the combination.
Yeah, exactly.
One thing that's still not clear is whether arbitrage should be folded into this or it should be considered a separate task, which maybe could be optimized and mechanized, but the betting and the arbitrage could be separate to some extent.
They could be separated, but I guess, I just, at least in terms of designing a prediction market, I would say I want the market operator to do all that for me, and not have the traders be doing it.
I think there's also the other side, which is the fact that sometimes things can go wrong keeps you from making a particular trade, which means you haven't brought your information. I mean, suppose I am really confident in this butterfly spread,
right?
But I don't want to take the risk that I buy 3/4 of it and get screwed on the other quarter.
Right, yeah.
I haven't brought my information in. Forget whether or not it would have created an opportunity for arbitrage.
Right, exactly. So this is the execution risk. It's like I'm in the middle of buying these 12 different things that I have to do, and all of a sudden the price changed on the last thing. Yeah?
Even if there's no execution risk, there may be counterparty risk unless the exchange does its own clearing. You will do 3/4 of the butterfly, and number 4 is AIG, and they go bankrupt.
I see.
It's still just execution risk. Right?
I think
No, everything is in the same nanosecond. When you come to collect, they're bankrupt.
I see. Well, it's another type of risk, yeah. Okay, so I guess the point is that the continuous double auction is a great invention, and it works great in many cases, but it was invented when auctioneers were people. And so, of course, it had to be dead simple when it was invented, maybe 100 years ago, at least. So, because a person had to sit there and sort these things and figure out who, be at the center. But of course, as we all know today, auctioneers are not people. Auctioneers are computers. And for now, all we've done is taken what a human did and automated it and had the computer do the same thing. But that now we realize, the computer can do a lot better than that. So even though this is true, this has remained the standard. So I'm going to argue that we should, be doing better with our auctioneer. So, and I'm arguing in this talk for a combinatorial type of auctioneer. And I guess an informal definition of a combinatorial auction or combinatorial market, combinatorial betting market, is one where the users can just construct their own bet, like kind of on the fly. They can define whatever bet they want to make. They just construct it by composing or mixing and matching lots of different options. This is there could be exponentially many things they could do. And kind of like ordering a Wendy's hamburger. So recently Wendy's had a little joke about combinatorial math on their bags. Okay, but here's a real example. So this is a real site. It's called Weatherbill, and this really does implement it. And this is an example of a company that's going in the right direction, I believe, and it's really making the system much more efficient. So you can go on Weatherbill. It's a site where you can buy insurance, insurance against weather. So this is a hypothetical example where I want to take a vacation at the shore in Atlantic City, and I want to say make sure it's a sunny, I want to insure my trip to my vacation. So I guess you can't really read this, but there's a huge number of options I can have here. So first of all, I do a rainy day type contract. They also have things about temperature and other things, and I pick the dates, I pick the country, I pick the nearest weather station. They have one that's in Atlantic City. Then I say exactly what I want to be paid. So it says I want to be paid $100 for every day it rains more than 0.5 inches. But only start paying me after one of the such day, and max it out at $500. So if there's more than 5 days, just give me $500. And so I set all these things, and it just says, boom, $42.62. And this is how much. Then I say, okay, yes or no. Do I want to accept this insurance contract? And it also tells me, I guess, historically what I would have been paid in the past. So this is more like what it should. This is an example in my mind of a combinatorial market maker. I'll just give one more example of how it might work. If you think of March Madness, right, the sports tournament, NCAA men's basketball, where there's a single elimination tournament of 64 teams. So there's 63 games. There's there's a huge industry in trying to predict what will happen. And of course, in Las Vegas, you can bet on lots of different things. And but it works like I described in the beginning, where every type of bet is explicitly listed on some. You walk into a casino and they'll give you a big list of everything you can bet on. So by definition, that's relatively small, at least polynomial size. And everything works independently. So the idea of a combinatorial version of this would be, okay, I'll let you bet on any property you can imagine about that tournament. So you could bet on something like, oh, I think Duke will do better. Duke will advance further than UNC. Or I think ACC will do better than the SEC. Or I think ACC will win at least 5 games. Or basically, I can construct any property I want. There's 63 games, so there's 2 to the 63 ways that tournament can unfold. So there's 2 to the 63 of these properties, kind of high-level properties. So of course I could never list them all out, right? 2 to 63 things, but it doesn't mean I can't operate a market like that. So, and I'll get to that a little bit later. I guess the other advantage of this, which I mentioned, was the logical and probabilistic reasoning can be handled by the system. So, for example, if someone bets that Duke will win the whole tournament, that should automatically increase the odds of Duke winning in the first round, right? If I think that Duke will win the whole thing, of course I also think that they'll win in the first round. So these kinds of things, so enforcing the logical constraints and propagating the information appropriately should be handled automatically. So why would I want to do this? What are the advantages? Basically, it provides more choices to the users, right? So if it's real money, if it's an insurance type product, there's more hedges, right? More specific. If I'm a business and I'm in this exact location and I'm a ski resort, there's only certain things I want to hedge against that. So I can get very, very specific. And in terms of the prediction aspect, I can get more information. So for example, in the election, if I had a combinatorial combinatorial market on the election of all 50 states, I not only get the probability of a candidate winning in each state separately, but I can get the correlations, right? I can get which states will break together, like Ohio and Florida, or California and Nevada. I can get these kinds of correlations, which you can't get otherwise. So more information, also better processing of information, so letting the traders focus on, forget about arbitrage and forget about these mechanical tasks. The computer does that better anyway. The traders can just focus on giving me their information in exactly the form they want to give me, and I'll take care of the rest. And the last advantage is like smarter budgeting. So for example, if it's all going into one system, like let's say I bet that Duke will not win the tournament, and I also bet that UNC will not win the tournament. Well, I can't possibly lose both of those bets. At least only one of them can win, right? So you only need to reserve. If I put $100 on both of those, you only need to reserve $100. You don't need to reserve $200. So if they were two totally independent markets, you'd have to reserve $200 if you're not smart about it. So I'll just make a distinction between combinatorial bids and combinatorial outcomes. Combinatorial bids, all that means is bundling outcomes together. So, for example, I want to bet that the Western Conference team will win. A Western Conference team will win. Instead of buying 15 different things, let's say in the NBA, I think there's 15 different Western Conference teams. Instead of buying each one individually, I buy them all in a bundle, all at once. Or I want to bet that gas prices are in some range. Instead of buying each piece of the range separately, I can just buy the whole bundle. And I guess I argue that this type of bundling is, there's almost no disadvantage. We can use linear programming to do the clearing, and so it's polynomial time. You get all the advantages of the last slide, but none of the disadvantages. So I'd argue that really we should at least be doing that. And interestingly, there is very few examples of that in practice. I guess Goldman Sachs had a market that's pretty small scale where they did this kind of thing, but it kind of went away. It didn't. Most markets out there are still this sort of independent CDA type situation. Okay, but the more interesting case, and the case I'll talk about for most of the talk, are combinatorial outcomes. And this is the case where the outcome space itself is exponentially sized. So this is like the March Madness example that I just gave you. Well, if you have an exponential sized outcome space, you pretty much also need bundling. It almost doesn't make any sense to have one without the other. To have this one without that one. But the other thing is, as you might imagine, once you have combinatorial outcomes, the algorithms behind it become computationally intractable. But I guess I'll just say don't give up hope yet, because later on, I think there is a feasible way to go about this. Yeah, question?
I have just a general question.
Sure.
So if you're betting on something like March Madness, then usually there's the house part, right?
Right.
Let's say you pay 5% to the house. So if you're in the business on trying to make money off of such a betting scheme, asymptotically you will always lose money. right? If the house is good at approximating at which probability certain things will happen in the event. So if you're going to lose money right from the beginning, like why bother with all of this?
I guess more than half the people think they're smarter than half the people. People are overconfident about how much they know. I think this is why people.
One thing is what people think, but if the house has this ability to predict the best possible way, then.
No, I'm not saying the house is able to predict.
The house uses the. Well, anyway.
I'm just saying that maybe the house has a You're saying it's a negative sum game. It might be a negative sum game.
Yeah.
So it is true that the whole group of population of traders might be playing a negative sum game, but.
That never stopped anybody.
Yeah.
Right, exactly. Every market.
That's entertainment, right? We're talking about serious. Well, anyway.
Well, actually, we will get later to if there's a market maker. If I really run an automated market maker, which I'm going to get to later, that market maker, the ones, for example, the ones Todd ran in Microsoft, that market maker, in expectation, it will lose money. So in that case, you're actually paying. You can think of it as the market is paying paying for the information that traders are giving it.
A quicker answer to Darko is, why do you buy insurance? Insurance companies have to be profitable, so clearly buying insurance is on average unprofitable.
That's true, yeah. Yeah, if you're doing it for that reason, if you, yeah.
Well, okay.
No,
You don't buy insurance against Duke winning, right?
Yeah.
Well, okay, it's emotional insurance.
But most people do it the opposite way, where they bet on their favorite team. But
I do the opposite. I do the emotional.
yeah,
And
yeah.
I win. I lose emotional.
Yeah, go ahead.
So I guess I have another kind of question. If you're using a market for information, like an election or so on, then it seems as if giving the traders more choice might actually be bad, because somehow you only get information about the things that they are choosing to bet on, and those might not be the things they're so interested in.
Yeah, so there's I guess I didn't have a slide of disadvantages, but that is one of the disadvantages, that there's just so many choices. Like if in this combinatorial setting, there's so many things traders could pay attention to. It's sort of fragmenting liquidity across many, many different things. So, but I guess if you really had a good sense that you didn't care about correlations, then you wouldn't want to run this combinatorial market. Or if you. Yeah, go ahead.
That's one thing I'm confused on, actually. So will this actually increase liquidity or decrease liquidity? Because on the one hand, it fragments liquidity across many, many more options. On the other hand, you're sharing information among things that used to be independent, like someone winning in the first round and someone winning overall. So
right, that's a good point. So I guess I say this, if you fix the number of outcomes, allowing combinatorial bids or allowing this kind of bundling is increasing liquidity for this exact reason. Like you're putting everything in one pool that used to be separate. So this part is increasing liquidity, but then the other thing is if as you increase the number of outcomes, you're fracturing liquidity. So you're right to be confused. That this is bundling helps with liquidity, but increasing outcomes hurts. Yeah.
The number of possible bets goes up. How does a house find a counterparty to a bet? Like if I want to bet that in the March Madness the home team will lose in a prime number of games, how am I going to find a counterparty for that?
Okay, so this goes to I think the very next slide. Yeah. So the answer is you probably won't. So if you run a pure auctioneer, at least in my opinion, if you ran a pure auctioneer who an auctioneer is defined as someone who just finds counterparties and finds people to match up, never takes any risk of its own. That's like the continuous double auction case. In this combinatorial setting, it is hard to imagine that there'd be much trading happening. So what probably what I would argue would work better is a automated market maker. So what that is like the institution itself is always willing to take a bet at all times. So you come up, you define this crazy one like this team will win a prime number of games, and you say, what's the price for that? And the market say, 32 cents, and you decide if you want it or not. So that helps with liquidity a huge amount, obviously, and you can sort of think it as infinite liquidity. At least there's some price at which you can do any trade. So but the thing is, this market maker will lose money on average. It's just an algorithm that sets prices, and in expectation it will lose money, but we can put a constant bound on that loss. So you can think of that as the cost to get the information. So if you truly wanted that information, you're willing to pay something, you can think of that as funding this market maker. And this helps with this problem. I mean, really, if you didn't have that, there could be a chicken and egg failure where, not many trades are happening, so traders even just go away, and it spirals. Okay, so there's a whole bunch. This is somewhat recent, I guess, since 2002, where we have very good pricing algorithms. This is the most common one, and probably the best. It is the best one, I believe. Robin Hansen's logarithmic market scoring rules market maker. It's a very nice price. Well, I won't get into details of it, but this is a nice way to bound the loss of the market maker. And we have another paper which has a whole family of this type of bounded loss market makers, and there's another type of market which I call dynamic parimutuel market, which you could also think in this context.
They always lose money?
No, they don't always lose money. They just, I guess I'm just saying that in expectation they're going to lose money because
They always risk money.
they always risk money. Yeah, that's definitely true. But because you set it up at the beginning when there's less information, it's pretty much guaranteed that the traders, sometime in the future will have more information than the market maker had at the very beginning.
Just imagine a world where the market maker makes one trade. It either wins money or it loses money. It can win money, but it's risking losing money.
It'll risk losing, but I also say that on expectation it will lose money.
I don't see that. Why? First of all, it could always add some charge.
Oh well, yeah, that's true.
Why can't the market maker adjust the charges and use the information dynamically as it's aggregating in the market?
No, you're right. Okay, yeah. Well,
it makes one trade. What's it going to set the price at where it's guaranteed to make money? It makes one trade.
No, he's saying it could adjust.
We're not talking about a guarantee. We're talking about expectation. And in one trade, he can calculate what he believes the expectation, and then
Everybody. Okay, it's fine. It makes a zillion trades. Everybody buys food. Nobody sells food. Everybody buys food, unless you're charging.
Reduce the price.
It doesn't matter what adjustment
you're doing worst case analysis.
Yeah.
But that's a very
Maybe if you say
unlikely
bound is
scenario.
worst case.
Well, if you adjust over time, you'll increase your bound. So this bound is for a very, very specific algorithm that does not adjust over time. So you can improve your expectation if you're willing to risk or increase your bound on worst case.
So you might want to do that.
You might want to do that. Yeah.
How deep your pockets are.
Yeah, you probably would. In fact, if you're really doing this for real, you probably would want to do that, and you'd probably want to charge a transaction fee and try to make it all back. Yeah. Well, yeah. Okay. What time? Ending around 2:30. Okay. So, okay, now I guess I'll get into more of the details of the technical details. So, there's three types of combinatorics I'll talk about. And actually, I'm really only talk about two of them in detail. One of them is Boolean logic. That's like this tournament type of combinatorics. There's, say, a bunch of binary variables, like 63 games that can each go one way or the other. And the things people can bet on are Boolean functions, right? Boolean combinations of those events. And then what will happen is, as you might imagine, these things, in the most fully general case, it's going to be intractable. But then we can look at special cases, try to look at special cases where it might be tractable. So in this case, we found one that is tractable and one very simple one that's still intractable. Then I'll talk about another type of combinatorics, which is permutations. So this is literally, think of a horse race. There's 10 horses. There's 10 factorial ways that race could end. And then you can bet on properties of orderings. Like, I think A will do better than D. Things like that. And again, the most general thing will be intractable, but then we'll look at special cases. And I'll just describe this one and give the result, but I won't go into detail. There's another one we just recently started looking at, taxonomy betting, where in this case the outcomes are n number, the cross product of n numbers, n discretized numbers, but they're laid out in a taxonomy so that at the bottom are these numbers, but then we have a hierarchy, and different nodes in this tree equal the sum of everything underneath it. So I guess the application we have in mind is predicting page views on a website that has a tree structure. And you might want to try to predict the leaves, or you might want to try to predict the parents. And so what we find is, I'll get to the result later. Okay. So first I'll talk about permutations. So this is, think of a horse race, right? Think of a horse race literally with horses, or not so literally, like a horse race among candidates in an election or among stocks in a stock market, etc. In a fantasy football. Okay, so we want to give probabilities for every possible ordering. And, as the number of horses goes up, the number of orderings goes n factorial. So eventually we do want probabilities on every possible thing that might happen. But of course, people don't want to give those probabilities. They want to give high-level things like the probability that A will win the race, or the probability A will finish in some range, or a probability that A will beat horse B. Okay, so these are the bids that are coming in, the bets. Okay, so first I'll talk about this auctioneer problem, where the auctioneer wants to make sure it never loses money. It just wants to match people up. And it's really a linear program that we can set up to solve this. So, okay, this is an example of a match. Someone's betting that A will do better than B. Someone else is betting that B will do better than C. Someone else is betting that C will do better than A. And everyone thinks there's a 70% chance that will happen. And so they're willing to pay 70 cents on the dollar. So the auctioneer is perfectly happy and safe to grab all three of these, right? Because it collects $2.10, but then the auctioneer knows there's no way that all three of these can happen, right? There's a contradiction, logical contradiction. Only exactly two, at most two of those three, I guess exactly two of those three will happen. So collects $2.10 and only gives back 2 at most, and so they're happy. So this is what we call pair betting, where bets are like A beats B. So very simplified language. But so what we found out is that these cycles are important. So if you ever find a cycle in this graph where the price is high enough, then the auctioneer is safe and can grab it. That's a match. But it's not an if and only if. So there do exist matches in that graph that aren't equivalent to cycles. And so, in fact, even though finding a cycle is polynomial time, the matching problem is NP hard. On the other hand, a different type of restriction, if we say horse A will always, if all bets are like what we call subset bets, horse A finished in this range of positions, that we can solve in polynomial time. So we set up this linear program, and then we have a bunch of linear program. Let's see. I think we have to keep solving linear programming with maximum matching in the inside loop, but we can do it in polynomial time. Okay, so the Boolean case is similar, and so I'll go through it pretty quickly. In this case, it's like the tournament example that I set up at the beginning. There's binary events, and in general, people bet on Boolean formulas. And again, the auctioneer problem is to ensure they won't lose any money. So here's an example of match in Boolean logic. Here's A1. Someone's buying A1. Two different people are selling A1 and A2 and A1 and not A2. And really, you can think of this as selling A1. So here's a buy for A1. Here's a sell for A1. The auctioneer is perfectly safe to grab all three of these, because no matter what happens between A1 and A2, the auctioneer can never lose money. So we have a bunch of complexity results here. In this setting, probably the most interesting one from a practical point of view is this box here. So this is for divisible orders. So it's perfect. It seems very reasonable in this setting to have divisible orders. What that means is, like, if I'm willing to risk $100 to win $200 on some prospect, well, I'm probably also willing to risk $50 to win $100. There's not much reason why I wouldn't accept that smaller one at the same odds. So this is divisible orders with large number of events, but it's co-NP complete. The indivisible orders make it a lot harder, but I don't think traders care that much about indivisible orders. Okay, the last thing I'll talk about is the market maker. So I mentioned probably the market maker makes a lot more sense in this setting. So this automated market maker, it's just a pricing function. It tells me, given what everyone has bought in the past, given a list of orders that have been accepted in the past, what price should I charge right now for everything? And mathematically, it's very simple. Of course, in a combinatorial setting, it involves a summation over exponential number of things. So I'll get to what we do in that case. Well, and so as you might expect, because of that, almost everything here is sharp P hard. So it's like counting, about as hard as counting, satisfiability counting. So these are recent results from some papers we published in 2008. In the permutation setting, even that case of subset betting that I mentioned is sharp P hard. So I don't know if you recall, but in the auctioneer setting, we could do it in polynomial time, but in the market maker setting, it becomes sharp P hard. Pair betting is sharp P hard. Even Boolean betting with two clauses is sharp P hard. I guess the only one we found that's somewhat interesting that's polynomial time is what we call restricted tournament betting. And what that is, if you restrict it to, in the March Madness type example, if you bet some team to win, and let's see, all the bets are like team A wins in round K, we can do that in polynomial time. And there's some kind of using a Bayesian network representation to compute this pricing function. Okay. Everything seems very pessimistic, but I'll get to a more optimistic spin in a moment. But okay, this is a summary of all the results we've had over the past, say, I think, 3 or 4 years on the complexity results of combinatorial markets. So these are the different types of combinatorics, permutations, Boolean, taxonomy that I mentioned, and different restrictions of languages. So this is the general case, but then pair betting, subset betting, etc. And then this whole row is auctioneer, and this whole row is market maker. So I guess the bottom line is almost everything here is NP hard, almost everything here is sharp P hard.
Can you use the prediction market about the publication dates of those 09 papers?
Right. No, it's been accepted. Right. So we found a few interesting cases where it's polynomial time, like this restricted tournament market maker is interesting, and this subset betting auctioneer. But I guess I want to say just don't get too pessimistic. Don't give up hope. I mean, I think if you actually really wanted to implement a combinatorial market, what you'd probably do is do general case, like basically allow any kind of bet you want, but have approximation in the pricing. So we have this pricing function, and it's a sum over exponential number of things, but we can just do sampling for that. We can do an importance sampling, or that's probably the best thing to do, some kind of importance sampling. I guess the reason that would work is, I mean, most things people want to bet on have reasonable chance of happening, right? So people bet Duke will do better than UNC. That has some reasonable chance of happening, probably. So we can approximate that. We can do sampling. I guess the things that we're sampling will fail are these very, very extreme things, like a 1 in a billion chance. And so what would happen in that case? Well, the market maker would just have to round off in its own favor. And so if the market maker thinks it's a 1 in a billion chance, but has a really high variance, it'll just say, well, if you really want to bet on that, I'm only giving you 1,000,000 to 1 odds, something like that.
But there are good MCMC techniques now to do very rare things.
Okay.
You do a succession of problems, each one contained in the other.
Okay, actually then I probably want to talk to you after this talk.
There's been a big activity in the markup community.
Okay, great. Okay, so if you want to find out more, you can, I have a blog post which basically parallels this talk and has pointers to all the different papers. And in fact, might be organized very similarly, maybe better, organized better. So you can go read about it here. If you didn't write down the URL, you can search for it on live. Sorry. Okay, so we built a couple of these things. We built this internal. So far, this one's not public, but internally we built a little thing to play with, a March Madness constructor, where you can pick any of these funky propositions and it will price it for you. I guess one thing we built that is public, it has it's a game called UPick, and I think I'm connected. Although slow connection. So it's not a combinatorial market, but it has combinatorial bids, I guess, when I describe the distinction. So the thing here is it's a sports betting thing, but you can, instead of betting against the spread, you pick what range you think the spread will fall into. So you have a little slider, nice kind of slider widget, where you say, okay, here's this game between San Diego and Pittsburgh. I think Pittsburgh will win by between 2 and 11 points. And I'll risk 100. If I risk 100, this market maker is pricing it for me. If I risk 100, I'll win 149. And of course, if I pick something that other people think is a lot more rare, it's this market. This is using that market maker. If I pick a range that other people think is very rare, I can win a lot more. So I make my pick. And I'm on this Verizon card. It's pretty slow. And so because it's on Facebook, I can see what my friends are doing. I can follow them. I can try to do better than them. I can try to, The other thing is, and it has this kind of stock market type thing where I placed my pick, and now if later on, even before the game happens, I can settle it early. So here's my bet. I can settle now. I'll lose 2 points if I settle now. But if things change, if let's say lots of other people start agreeing with me over time, then the value of my bet will have gone up. I can sell early. It's like the buy low, sell high type thing. So you can play around with this if you want on Facebook. Okay. Just a few more comments, and I'm almost done. So that site I showed you at the very beginning, intrade.com, is run in Ireland. So most of the ones with real money are not run in the U.S. Because it falls under like a gray area of whether it's gambling or not. So luckily, there's some promise or some hope. The CFTC, which regulates futures markets, actually in May they came out with a call for help, I guess, a May Day, and they said, what should we do with prediction markets? Please tell us, or give us your opinion of how we might regulate prediction markets. And in fact, we sent in a proposal, and so there is some hope that maybe the government, U.S. government, will allow some kind of experimentation in this area. The nice thing about, or the thing that's giving me hope, is their call for help actually was very scholarly and they demonstrated that they actually understood the issues. And one more comment, and I think I'm done.
Wait, are they using the phrase prediction markets broadly, or the way we're using it? That includes all sorts of things, right? That has been regulated in the past.
Yeah, so that's part of what they're asking, is like, how can we carve out something that is socially valuable, but yet we don't want, probably under no situation can I imagine them regulating betting on March Madness. So some of the proposals are like, well, it has to be like economic or social consequence. The other thing is there'll be limited stakes, like you can have at most $500 in this system. Or the other thing is maybe like within a company you'll be allowed to put your own money into it within your own company, but it won't be open to the public. Okay, well, I'll just end with one more comment that it's probably another story for another day. But in some ways it's the same story, I'll argue. And that's that advertising follows the same thing as the financial world, where, when advertising was invented, the sales force and the marketers were people, and everything was manual over the phone. It wasn't measured very well. And really, this industry, as is almost every industry, is going the way of like automating everything. Automation. That's the way it should be. So, computers learn what ad is best. Computers mediate the sales, like decide what things to sell and what not. Through an auction type process, they also do the measuring and decide what works and have a feedback loop. And the things advertisers are buying, instead of like a real estate metaphor, they're buying, very, very specific things with combinatorial features like the type of user, the what's on the page, the time of day, everything. And so, although it seems a lot different, the same kind of thing is happening, well, in industries all over the place, but of course, Yahoo and Microsoft care a lot about this particular industry and how it's going. Okay. Thanks a lot. Yeah?
So going back to your seemingly pessimistic table about all these problems.
Okay.
So in the auctioneer row, just see if I can understand exactly what is the problem that's hard. Is it, lots of people say they want to make these bets. Is it the problem of just finding the maximum set of bets you can accept that you're claiming is hard? Or
Right. No, not the maximum, just finding any set of any match, the existence of a match. Right, the auctioneer row is by definition a worst case setting. The auctioneer wants to say, in every single state of the world, I won't lose money.
So in practice, you might want to do something very different. Like lots of people make sort of typical bets, and you just want to make sure you're accepting plenty.
Yeah, but then I guess I'd argue in some ways that's like a market maker, because you're taking. I guess my distinction here is that market maker takes risk and the auctioneer does not. So.
But you could be not taking risks, but you're not doing it perfectly. Sometimes you reject someone's bet, when in principle you.
Right. Okay, right. Yeah, in fact, we can do that. So, for example, in the permutation case, we can just find all the cycles, and I know I'm always safe finding cycles, but I might miss something. Yeah.
And then maybe there's sort of one level smarter than that that's still.
Yeah.
I have a similar question.
Okay.
If I can just throw an integer programming solver at this thing. Two questions. One, how often is the problem actually too big for the solver to come back? And secondly, if the solver comes back, takes 2 minutes, you just say no trade. It doesn't matter that the answer might be wrong.
Yeah, so these, like with every complexity result, the practical implication might be different. You might be able to do this. I don't know the answer.
Timer on your solver works just fine. But to my first half of the question, would a solver? Imagine you had a market with 1,000 traders, and it's March Madness. It's 2 to the 64th or whatever.
Yeah.
Do we actually expect it wouldn't be able to find things?
Well, honestly, I don't know, because it's not been done. I guess my personal view is I'd rather do this market maker with approximation than do the auctioneer one. But
so the hardest result does not hold for 1% of approximation. If you're satisfied with 1% of approximation, they are not hard anymore, or you are not sure?
Yeah, I'm not sure. Yeah, this approximation here is not. There's no guarantee associated with this. It's just we're proposing important sampling. So there's no hard guarantee, at least. There's, I guess, yeah.
This is not to do with the math, but 1% may not suffice, given that the credit default swap market is $50 trillion. You don't want to be out 1% of that.
Yeah.
I think we'd all be happy with only being out 1% of. That's right. We'd all be happy if we found that the final price tag was only.
Oh, collectively, yes, but not me.
I don't think you tell the difference.
Touché.
Okay.
Okay, thanks a lot.